Good morning, everyone, and welcome to Tax Cuts and Jobs Act Update and Tax Planning. I'm Vinny Civitello, Communications Manager for the New Jersey Business and Industry Association. With us today is Maria Rollins of KRS CPAs. A few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you tomorrow, along with the PowerPoint for today's presentation, so be on the lookout for those. I'd also like to draw your attention to the Questions tab. Maria would be happy to take all of your questions, so don't hesitate to write them in as they come to you. And I can't stress that enough. Write them in as they come to you, or you might forget what you wanted to know by the time we get to the Q&A. So now let's get things started. Maria?
Good morning, everyone. Thank you for joining us here today on this very exciting topic of the Tax Cuts and Jobs Act. I've been spending a lot of time on this, as my fellow CPAs, I'm sure, have all been too. But what I want to do is just make sure that everyone understands that this is something that every business owner and individual will be impacted by, so you can't ignore it, and don't wait for your tax advisor to contact you. You must reach out to them and get going on this very important tax change. So today's agenda, what I will try to do in an hour, I'll try to keep it to the hour, is review the key provisions of the Tax Cuts and Jobs Act and talk a little bit about those August proposed regulations that we got, particularly with Section 199 Cap A. We'll talk about some tax planning considerations, and how I would like to do that is just talk a little bit about what we're doing with our clients and the conversations that we're having with our clients on these matters. And then we can recap with some questions, and as Vinny said, get those questions going, and we'll be happy to address them at that time. So let's jump right in, because there's a lot going on here. The Tax Cuts and Jobs Act, as we accountants are using the hashtag TCJA, was signed into law December 22nd, 2017. That's right about the time that being a CPA was kind of cool, and everybody was contacting us to find out if they should prepay their real estate taxes. And it was kind of, you know, your accountant was the person that you wanted to talk to at your holiday table at the end of last year. So this is the most comprehensive tax reform since 1986. And I just had a recent conversation that a lot of tax preparers that are preparing taxes today weren't even around or preparing taxes. They were around, but they were not preparing taxes in 1986. So this is something new to a lot of tax preparers to see this type of reform. And you can imagine the burden it's going to put on the IRS as we're working through our tax filing season coming up in beginning in January. As I mentioned earlier, it impacts individuals and businesses. It will impact every individual and just about every business as you work through these provisions. So let's talk about, we'll talk a little bit about C-Corp deductions. I'm not going to get too deep into C-Corps. My focus today will primarily be spending a little more time on the 199 Cap A. We'll talk about some depreciation deductions and how bonus in Section 179 was changed. I'll get into a little bit of the small business accounting method. This is something that you don't want to ignore. It could really make a difference for your small business. A little bit on deductions and losses, and very, very light on the 1031 exchange. My feeling is that's kind of been out there for a while, and we've worked through a lot of that. The new regulations do have some clarification in there, but I really want to try to keep this at a level that we all can enjoy the next 60 minutes. So talking about corporations, we've all heard that that corporate tax rate now is going to be at a flat 21%. This is great. This is wonderful. It kind of evens the playing ground for U.S. corporate taxpayers, and I don't think anyone is upset about this change here. This is a good change in the act. If you're a fiscal year taxpayer, you're going to have to bifurcate your taxable income pro rata, and you'll use the tax rates that were in effect prior to 12/31/2017 and the 21% after that. Another interesting component here is personal service corporations that were once taxed at 35% are going to be taxed at the same rate, 21%. So we think that's good too. AMT is repealed. And there will be a refund mechanism for any unused AMT credit, and of course with any credit or provision in the Internal Revenue Code, there will be limitations. NOLs, this is important. Net operating losses are limited now to 80% of taxable income. We're going to be denied a carryback, and we'll have an infinite carry forward period, of course, subject to that percent limitation. We no longer will have the domestic production activity deduction. That's the former 199. We'll talk about the new 199 Cap A a little bit later. And like-kind exchange gain deferral is now for real property only. That's not only for C corporations, that's for taxpayers in general, but we're only going to be using like-kind exchange deferral when we're dealing in real property. And there are lots of rules and regulations surrounding that. So let's jump right into section 199 Cap A. So that is what we are referring to as the deduction for qualified business income. You'll see the term throughout here, QBI, but that's what it is. It's qualified business income. And this is for periods beginning after December 31st, 2017, and it's an 8-year period. It's going to end before January 1st of 2026. So it's important to understand as we go through these rules and any kind of significant changes that you want to, tax plan changes that you want to make, such as changing your entity classification. As it is right now, this is an 8-year period. And who knows, with the change in administration, it could even be shorter. We just don't know. But I just want to throw that out there so everybody's aware of that. Another interesting aspect of this deduction, because we're talking about business income, the deduction is actually taking on the individual tax return of the pass-through entity owner or business owner operator, and it'll apply to some estates and trusts. So this is important because it's a deduction that applies to your business income, but the deduction is calculated and taken on your individual tax return. So you could have one spouse that's active in the business filing a joint return. It's taken on that individual tax return. It's not available for wage income or business income earned through a C corporation. So this is for business income. If you're active in the business and you receive a W-2, it's not going to qualify. That wage income that you receive is not going to qualify for this deduction. The deduction is 20%. In general, 20% of the QBI for each of the taxpayers' trades or businesses. It's a very simple statement, but it takes a lot of work to get you there. And 20% of REIT dividends and qualified publicly traded partnership income. I like to think of that as 2 buckets. So you have a bucket of your qualified business income for your trade or business, and then you have the other bucket of calculations. The deductions cannot exceed 20% of your taxable income reduced by net capital gain. So it's 20% of your business income, and then you have a limitation of 20% of your taxable income. As I mentioned earlier, taxable income on your individual tax return, not the business taxable income. So let's dive a little more deep into this calculation and how 199 Cap A works. So there's an income phase-out range that's very important, and we'll get into specified service trades of business, why this is very important. But for single taxpayers, you're filing your individual tax return. If your income is below $157,000 and you have a business with pass-through income that qualifies, you will get to take the deduction without any further calculations. It's pretty simple and basic. That deduction will phase out between the $157,000 and $207,500 of income. Married filing joint return, that $315,000 is the lower end of the threshold. If your income is below that number, you'll take advantage of the 199 Cap A deduction without any further calculation. If it's within that phase-out range, there will be a calculation to reduce that. And then if it is above the top end of both of those phase-out ranges, there's a whole other set of fun calculations that we can do to tell us what our QBI deduction will be. So let's start with the simple basic below your income on your individual tax return is below the income threshold, you calculate the deductible QBI for each qualified business, which is your qualified business income times 20%, and you'll apply the overall taxable income limitation, which is 20% of your taxable income on your individual tax return less your capital gain, and your deduction is equal to the lesser of 102. Pretty basic, pretty easy. If you're within those ranges right now, you can make that calculation pretty easy. You can have an idea of what your taxable income and your deduction would be for 2018, and you're in pretty good shape. I have an example here of how that mechanically would work. We have a husband and wife that files a joint return in which they report taxable income of $310,000. So they are below the $315,000 income taxable income threshold. Of the $310,000, $10,000 is net capital gain, and $280,000 is ordinary net income from H's interest in an S corporation. H and W combined QBI is $56,000, and that's the very simple calculation of 20% of QBI, 20% of the $280,000. Combined QBI is $56,000 before applying the overall limitation of $60,000, which is the taxable income less the capital gain times 20%. So this taxpayer, husband and wife, they will have a 199 Cap A deduction on their individual tax return of $56,000. So as you can see, it's a nice deduction. It's something that we wouldn't have had, and it kind of helps get us closer to the 21% tax that C corporations will be enjoying going forward in 2018. I have an issue with this example, though, because it's an S corporation, and all of the taxpayers' income is ordinary income from the S corporation. And in the real world, and I'll touch base a little bit later, in the real world, an S corporation must have reasonable compensation to their shareholder owners. So this example kind of makes it very, very basic, but I do have an issue with that example there. Okay, so now we've talked about taxpayers that are below the income threshold. So now what if you're a taxpayer with income above the threshold? There are additional rules that will apply, and hopefully as you work through those rules, you'll still get some benefit of the 199 Cap A. If you don't, we'll talk a little bit later about tax planning that can help you get there. So if your income is over the high end of the threshold, your income from your pass-through business, sole proprietor business, must not be from a specified service business. That's a new term, and we'll calculate and we'll talk about what specified service business means a little bit later. But the income from a qualified business, there's a calculation that you're going to look at your W-2 wages from the business and the capital in the business. So the qualified business, the deductible QBI amount is equal to the lesser of 20% of the business's QBI, it's the same calculation, or, now it's the lesser of these two, or the greater of 50% of the W-2 wages for the business, or 25% of the W-2 wages plus 2.5% of the business's unadjusted basis in all qualified property. So the deduction is now contingent upon whether or not the business has W-2 wages or qualified property within the business. So we'll take that a little bit further and just talk about what, before we go any further, what W-2 wages mean. So W-2 wages are total wages subject to wage withholding. They're elected deferrals and deferred compensation paid during the year. So that there's a clear definition of what wages are in that calculation. Now, the basis of qualifying property, so that's your depreciable assets. The basis of qualifying property is calculated as the unadjusted basis immediately after acquisition of the property. And qualifying property means tangible, depreciable property held available for use in the business at the close of the taxable year. And it's used in the production of QBI at any time during that year, for which the depreciable period has not ended before the close of the tax year. The depreciation period starts on the date first placed in service and ends 10 years after the beginning date. So in general, we have a 10-year period for an asset that is placed in service that we get to use the original cost basis of that asset in our calculation. So if I purchased some heavy equipment and I purchased it today under this calculation, even though it may be fully depreciated in 5 years, I get to use the original cost basis of that asset for 10 years in this calculation. It would stay on my book. So what we're looking at now for some of our clients is not to drop off fully depreciated assets. You don't necessarily lose them if you're dropping them off your depreciation schedules, but we want to keep it the calculation as easy as possible. So to the extent that you're not carrying forward assets that are fully depreciated on your depreciation schedules, you may want to go back and get them back on so that you can make this calculation in your business if you're over the income threshold. Okay, so I do have an example of the calculation of the QBI if your income is above the threshold. So H&W file a joint return in which they report taxable income of $450,000. They are above the joint threshold, of which $300,000 is ordinary income from the wife's interest in an S corporation that is not a specified service, trade, or business. Wife's allocable share of the business's W-2 wages is $80,000, and her share of the business unadjusted basis in the qualified property is $600,000. Husband and wife's wage and capital limitation is the greater of 50% of wages, $40,000, or the sum of 25% of the W-2 wages, $20,000, plus 2.5% of the unadjusted basis of the qualified property immediately after its acquisition. $600,000 times 2.5% equals $15,000 for a sum of $35,000. The amount of the wage and capital limitation is therefore $40,000. Husband and wife's combined QBI is the lesser of 20% of QBI, $60,000, or the wage and capital limitation of $40,000. In this example, we're going to be limited to the $40,000 deduction. Combined QBI is 40 before applying the overall limitation of 90, 20% of 450. Husband and wife's 199 Cap A deduction is 40,000. So as you can see in this example, there is room for interpretation of wages and qualified property. So as you can imagine, some of the regulations that came out in August address some of those areas and those questions. But that is a pretty basic example of a business where the husband and wife's personal, as I said earlier, individual return, taxable income is above the income threshold. So let's talk about a specified service business, because we did get some specification of this in those regulations. So taxpayers with taxable income, as I mentioned, greater than the threshold, have to look at what the business is and what areas the business is in. So you're denied a 199A Cap A deduction if your business is from a specified service, trade, or business. So what is that? That is defined in Code Section 199 Cap A D2 as any trade or business which is described in Section 1202E3 Cap A, applied without regard to the words engineering and architecture. So we have a carve out for engineering and architecture, or which involves the performance of services that consist of investing and investment management, trading or dealing in securities, partnership interests, or commodities. So Section 1202E3 Cap A describes any trade or business involving the performance of services in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, or any trade or business where principal assets of such trade or business is the reputation or skill of one or more of its employees. And that last phrase, the reputation of skill of one or more of its employees has really caused a lot of question and a lot of desire to have that further clarified, as you can imagine. Specified service trade or business. My business is one of those businesses. If my income is higher than the threshold, I will not be entitled to a QBI deduction. I'm out, and that's the end of that. The Section 199A QBI deduction is a below-the-line deduction, so that's important because it is a deduction that's going to be after you calculate your AGI, your adjusted gross income. So your adjusted gross income, there's quite other tax calculations that drive off of that AGI number. So QBI will not impact that AGI number. The 199 Cap A is available to both itemizers and non-itemizers. Our feeling is this year with the change, the increase in the itemized, the standard deduction, we will have more people filing as standard rather than itemizing, especially in these parts where you're losing your SALT deduction. You're limited to $10,000 on your SALT deduction. And we're seeing that a lot more of our clients will be taking advantage of a standard deduction. It's available. This is available to both itemizers and non-itemizers. The income thresholds will be indexed for inflation, and 199 Cap A, you're not going to take that in a loss year. There is a carryover of the loss. It's a carryover of the qualified business income. It's actually a qualified business income, a business loss that would get carried over into your calculation into the next year. So, okay. So let's talk about bonus depreciation. Bonus depreciation is a mechanism where the IRS has allowed us to write off the cost or purchase price of an asset immediately to some extent in the year that it's acquired. So what we've been working with is a bonus depreciation rate of 50% of the value of the asset. Under TCJA, that rate will be increased to 100% for property acquired and placed in service between September 28th, 2017 and December 31st, 2022. So with this point here, just be aware that this is something that actually may apply to your 2017 tax return. If an asset was purchased and placed in service after September 28th, 2017, you may have you had the ability to take 100% bonus depreciation on that asset and write it off on the 2017 tax return. You had the election, and it was an election to keep the 50% bonus depreciation on that 2017 tax return. And if you did make that election, the election would have applied to all of the assets that were purchased qualifying in that period. So you could have used the 50%, or you could have used the 100% on the assets placed in service after between September 28th and December 31st. This was a nice surprise when we were doing tax planning at the end of 2017, and like usual, we were scrambling to make decisions as we were doing our tax planning on the 17 year. Another very interesting piece, comment here is that these qualifying assets no longer have to be new. In the past, to qualify for bonus depreciation, if you purchased a used asset, it didn't qualify. You could not take bonus depreciation on that asset. It had to be new. And not just new to you, but it had to be new property, new equipment. You can take it now on used as long as the taxpayer didn't use the property at any time before acquiring it. The taxpayer didn't acquire it from a related party, so there's a rule there that it can't transfer from a related party. It wasn't acquired from a member of a control group. And the basis of the property is not figured in whole or in part by reference to the adjusted basis of the property in the hands of the seller, so transfer basis. And the basis of unused property is not figured under provision for deciding basis of property acquired from a decedent. So this is interesting, and it could apply in situations where you were previously leasing an asset, because it's not, if you didn't have a depreciable basis in that asset prior, and you buy it at the end of a lease, and now you purchased that asset, you could actually take bonus depreciation on that asset as long as you didn't have a depreciable basis in that asset. So this is a good addition here to this provision. After 2022, the bonus rate will be reduced by 20% annually. And they added qualified film, television, and live theatrical productions as types of qualified property. Okay, the other big depreciation write-off provision that was changed is Section 179. Again, Section 179, like bonus, allows you to take a accelerated write-off of an asset in the year that you place it in service. Section 179 has its own rules. And for property placed in service after December 31st, 2017, the maximum deduction you can take for under Section 179 has been increased from $500,000 to $1 million. So that's a write-off of the asset completely, up to $1 million in purchase price. There's a phase-out threshold where you lose the Section 179 deduction between $2 million and $2.5 million on Section 179 assets. That's an increase of $500,000. And they've expanded the definition of qualified property to include the following improvements made to non-residential real property after the date when the property was first placed in service. So there's qualified improvement property, which means any improvement to a building's interior except improvements attributable to the enlargement of the building, any elevator or escalator, or the internal structure framework of the building, roofs, HVAC, fire protection systems, alarm systems, and security systems. So between these two depreciation provisions that were extended here under this act, many businesses are going to be able to write off a significant portion of assets that they're purchasing and placing in service, either through the bonus depreciation or the Section 179. This holds important to the real estate industry, these types of deductions. Just be careful when you're doing your tax planning here. It's great, and to be able to write it off and match the cash outflow is a wonderful thing, but many states are not going to follow this regimen here. They're not going to allow, to the extent the Section 179, if they do allow it, and they are not going to follow the federal bonus depreciation. So when you're doing your tax calculations, and you may think that, hey, I just bought this very big piece of equipment and I have a loan on it, so I'm not going to have any taxable income, I'm going to write it all off. The state, especially the state of New Jersey, will come back and calculate your depreciation differently, and you'll have a state tax. So you don't want to have that sneak up on you. And the other thing is you can use both of these in the same year on different assets. So it's very generous, and as I mentioned, it's possible to have full expensing for tax purposes. Let's talk a little bit about luxury auto, because this comes up a lot in my practice. I have a lot of clients at the end of the year say, oh, I'm going to go out and buy a new SUV or a new car and use it in my business. There's luxury auto limits on depreciation, that if the vehicle qualifies as a luxury auto, you're going to have limitations on what you can deduct. So the TCJA changed the depreciation limits for passenger vehicles placed in service after December 31st, 2017. If the taxpayer doesn't claim bonus, so you're claiming regular depreciation, no bonus, you're electing out of the bonus, your luxury auto deduction will be $10,000 for the first year, $16,000 for the second year, $96,000 for the third, and $5,760 for each year in recovery period. So just be aware of that. You're not going to deduct the entire cost of a new car. On the other hand, if you claim the bonus depreciation, you'll have an additional $8,000 depreciation deduction in the first year. So again, this is only for autos that are subject to these depreciation, luxury auto limits. It's not going to apply in a vehicle or a truck that you're using, heavy equipment, those kind of purchases. It's really only going to apply to those that are qualified under these luxury auto limits. This was interesting. Small business accounting methods. This was interesting, I'm actually I'm going to be spending a lot of time looking at this for a few of my clients. So small business accounting methods, if you have annual gross receipts of 25 million or less during the preceding 3 years, and that's up from 10 million. It's 25 million or less over a 3-year period, up from 10 million under pre-TCJA law. You can qualify for the cash basis of accounting. In the past, you had to be an accrual basis taxpayer. You don't have to account for inventories, although you do have to have a supply account, but you don't have to account for inventories. You're no longer subject to the uniform capitalization rules. That was also a 10 million pre-TCJA. And if you make these changes, and this is really, really interesting, if you make these changes, any change in accounting method made pursuant to these provisions is considered an accounting method change, allowing the taxpayer to recognize ratably the taxable income resulting from the method change over a 4-year period, and you'll recognize losses immediately. So where I'm looking at this for some of my clients is if I was forced to be an accrual basis taxpayer, and that wasn't advantageous for me in the fact that perhaps as a cash basis taxpayer, I have more of a benefit of an income deferral, and I was forced to be an accrual basis taxpayer, and I am below that 25 million, I can change my accounting method to cash basis. I can take any loss in making that change immediately, and any income that I need to recognize from making this change, I can take in over a 4-year period. You would have to do an official accounting method change, file a Form 3115, but it is something to consider here as you're doing your year-end planning, if it makes sense to change from accrual basis back to the cash basis. And there was a rule that you couldn't make a change within a 5-year period of a change. That rule is not going to come in play here. Within the next 3 years, you can make the change and not be considered with that rule. So this is interesting. And I have, once 1015 is done and we get this final tax filing out, I'm going to be diving deeper in here with quite a few of my clients that are forced to be on the accrual method with inventory and uniform capitalization rules. If you're not familiar with that, those are rules that say you have to capitalize costs of production into your inventory for tax purposes, and capitalize them, not deduct them in the year that you incur those costs. So we have quite a few clients in our firm that are subject to uniform capitalization rules and are below the 25 million, but in excess of the old 10 million rules. So this is something that deserves some attention if you're within those ranges. It also look at the completed contract method versus the percentage of completion method too. This is the same thing here. Under previous laws, if you had average gross receipts of 10 million or less, and who estimate that the contract would be completed within a 2-year period, you were not required to use the percentage of completion method. Now we're at 25 million. And this is something, if you do make this change, if you're under these provisions here, you don't have the benefit of the 4-year period. So it's not held the same way, but it's something worth looking into if you're on the completed contract or percentage of completion method. Okay, so let's talk a little bit about the interest deduction limitation. So it applies if 3-year average annual gross receipts are 25 million or more. Deductible interest is capped at 30% of adjusted taxable income after certain adjustments. There is election to opt out for real property development, redevelopment, construction. And if you elect to opt out, you must depreciate your real property using the alternative depreciation system. So if you do opt out and you use ADS, you cannot take bonus depreciation, and ADS lives are longer. So just be aware of this if you're at that 25 million or more mark on your annual average gross receipts. It's something that I would put into my tax planning before year end. Okay, so let's get into some of these new proposed regulations. Is a hot off the press issued on August 8th. We've had a little time to go through the numerous pages of these regulations. Apply, I'll talk about the application to 199 Cap A. The regulations defined key terms, including trade or business, relevant pass-through entity, and RPEs, a new term, provides general computational rules for Section 199 Cap A, provides special computational rules for netting of negative QBI amounts with qualified REIT dividends and qualified PTP income, carry forward of negative QBI amounts from qualified trade or businesses, carry forward where sum of qualified REIT dividends and qualified PTP income is negative. 199A Cap A, as we talked about earlier, does not apply to wages. So the treatment of an employee, this was made a little more clear in the regulations. Treatment of an employee by an employer as anything other than an employee for federal employment tax purposes is immaterial. So what they're saying is that if an employer treats an employee as an independent contractor and they should have been treated as an employee, it doesn't matter. That income is not going to qualify. It's presumed to be wages, and the presumption that former employees are still employees is in those regulations. So that means, for an example, there, if I had one of my employees and I say, okay, why don't you become an independent contractor and provide your services to KRS, and we'll pay you as an independent contractor. That former employee is still considered an employee as far as 199 Cap A, and it can be rebutted. And I have a couple of examples, and I apologize, they're not on the slides, but I can go through them quickly. Let's see if I have one that really explains this. Here we go. A is an employee of PRS, a partnership as a full-time employee and is treated as such for federal income tax purposes. A quits her job for PRS and enters into a contract with PRS under which she provides substantially the same services that she previously provided to PRS in her capacity as an employee. For Section 199 Cap A purposes, because A was treated as an employee for services she provided to PRS and now is no longer treated as an employee with regard to such services, A is presumed to be in the trade or business of performing services as an employee with regard to his services performed for PRS. So these are anti-abuse provisions in here that are not going to allow you to play games with your employees to qualify the income as a qualified business income. Here's another example. C is an attorney employed as an associate in a law firm one, and was treated as such for federal employment tax purposes. C and the other associates in law firm one have taxable income below the threshold amount, 157 or 315. Law firm one terminates its employment relationship with C and its other associates. C and the other former associates form a new partnership, law firm two, which contracts to perform legal services for law firm one. Therefore, in form, C is now a partner in law firm two, which earns income from providing legal services to law firm one. C continues to provide substantially the same legal services to law firm one and its clients. Because C was previously treated as an employee for services she provided to law firm one and is now no longer treated as an employee with regard to such services. C is presumed to be in the trade or business of performing services as an employee with respect to the service C provides to law firm one indirectly through law firm two. C's distributed share of law firm two income, including any guaranteed payments, will not be QBI for purposes of Section 199 Cap A unless the presumption is rebutted. So in my firm, we have partners that have received K-1s and their income is passed through to them. And if someone was promoted to a partner and they started receiving that K-1 and that was based on merit, it could be rebutted and qualify for QBI. But there's the point is the regulations here do have anti-abuse provisions that are going to prevent games from being played to change your status from an employee to something other than that so that you can take advantage of the QBI deduction. Okay, how are we doing on time? Okay. The regulations, this is one part that we actually are waiting for, or hoping to get further guidance on, but I don't know because it seems like we have a 100-year history here that we haven't gotten the guidance, is whether or not a rental activity is a trade or business for Section 199 Cap A purposes. So for the definition of, for definition 199A relies on Section 162. And a 100-year history of cases and rulings that do not give definitive guidance. So this is a rental activity considered a trade or business. The same issue we have exists with our net investment income tax provision of Section 1411. So a rental activity that does not rise to the level of a trade or business is treated as a trade or business for purposes of 199A if the property is rented to a trade or business which is commonly controlled, regardless of whether the rental activity and the trade or business are otherwise eligible to be aggregated. So for example, in this case, for that last bullet point, if I have a manufacturing business and I own the building and I rent, my business rents from the building, I'm going to be aggregated in that case, and I'm not going to have an issue. It's going to qualify and not be a problem there because they're common owners and we're going to aggregate that business. But we would love to have additional guidance here under the rental activity, trade or business. And I know that the AICPA just sent a letter with 11 points, and clarification on rental activity as a trade or business is one of those points that hopefully will get the next set of guidance. So remember, these are only proposed regulations. There'll be a 45-day period where you can submit comments, and then from there, hopefully we'll get some final regs, hopefully before the end of the year, but we can use these proposed regs in the meantime as guidance as we prepare the tax returns for 2018. Okay. Another clarification that came out of those regs is that employer organizations, if you use a PEO, statutory employers and agents, the payments of those wages, in determining W-2 wages. Remember, we have a calculation. Now we have to go back and look at W-2 wages on our QBI calculation. In determining those wages, an individual or RP may take into account any W-2 wages paid by another person and reported by the other person on Forms W-2, with the other person listed as the employer. And box C are the Forms W-2. So if I use a PEO, I don't lose my wages for my calculation of my business because I'm using a PEO. They're considered my wages. W-2 wages are also allocated among multiple trades or businesses if multiple trades or businesses exist. There's lots of allocation rules. There's some clarification in the regulations on allocations and aggregation, and it's real important to understand those as you go through your year-end tax planning. Okay. So the proposed regulations provide guidance on whether certain items are treated as qualified property. So there's some anti-abuse here. I purchase an asset, I never use it, I use it in my calculation of QBI, and then dispose of it. It's not going to fly. So property acquired within 60 days of the end of the year, tax year, and disposed of within 120 days without having been used in a trade or business for at least 45 days prior to disposition will not qualify unless the taxpayer demonstrates that the principal purpose of the acquisition and disposition was a purpose other than increasing the 199 Cap A deduction. They clarify that basis adjustments under 734B and 743B and property acquired at the year end. So these are anti-abuse. the ability to purchase an asset and write it off or use it in your calculation is not going to work if it's not used in that trade or business at least 45 days prior to disposition. Proposed regulations 199 Cap A4 provides rules that allow taxpayers to aggregate trades or businesses. Aggregation is allowed but not required if certain criteria are met. And this actually offers some flexibility here with taxpayers. It's a good provision in there. It allows taxpayers to treat multiple trades or business as a single trade or business for purposes of applying the wage and qualified property limitations. The big note on this is this aggregation is going to apply at the individual level. It's not going to apply at the business level. In fact, at the business level, the example that I would give is if you have a qualified subchapter S subsidiary structure where you have multiple subsidiaries rolling into a subchapter S tax return, you're actually going to list those trades or businesses individually, not aggregating, and it could cause some compliance and reporting issues here at that level. The aggregation that we're talking about here is at the individual level, and it'll allow you to take those businesses and wages from different businesses, put them together, make your calculation, and you can be flexible about that. If it helps you, it's a good thing, and that flexibility should be taken advantage of. Okay, some more anti-abuse. The IRS observed that some taxpayers have contemplated a strategy to separate out parts of what otherwise would be an integrated specified service trade or business. Remember, specified service trade or businesses are not allowed a QBI deduction, such as administrative functions. So in this example, I have an accounting firm. I am a specified service trade or business. I am not entitled to the QBI deduction if my individual taxable income is above those threshold amounts. If I come up with a scheme and say, okay, I'm going to take my administrative department and I'm going to put them in another entity and they're going to provide services, administrative type services to my accounting firm, and I'm going to pay them a fee for that, and they will have a profit from that, and that income will pass through and qualify for as a specified trade or business. As not a specified trade or business and subject to the QBI deduction. That's not going to work. There's an anti-abuse rule that says that if a specified trade or business includes a trade or business that provides 80% or more of its property or services to a specified trade or business if there is a 50% or more common ownership. If a trade or business provides less than 80% of property or services to a specified trade or business with common ownership, the portion of the trade or business providing property or services to the specified trade or business is treated as part of that specified trade or business. These regulations get a little hairy and they get a little technical. I have a pretty simple example on this next slide here. We have a dermatologist provides medical services, which is a specified service trade or business, not allowed to have a QBI deduction if you're above the income threshold. Provides medical services to patients on a regular basis through an LLC, disregarded entity owned by A. In addition to providing medical services, LLC also sells skincare products to A's patients. The same employees and office space are used for the medical services and sale of skincare products. The gross receipts with respect to the skincare product sales do not exceed 5% of the gross receipts of LLC. Accordingly, the sale of the skincare products is treated as incidental to A's specified service trade or business of performing services in the field of health and is treated as part of the specified service trade or business. So we're not going to be able to pull out the skincare products and treat that as a qualified business. It's going to be incidental and it's going to be part of the specified service trade or business. So there's examples in the regs that's going to stop a lot of the schemes that we were all imagining could happen under these rules as they were written in so quickly in December of 2017. So let's talk a little bit about tax planning. I'm going to go quickly here because I want to be able to open it up to some questions. What we're doing in our office right now is we are looking at ways to maximize 199A. We're looking at entity choices for our clients. And we're looking at depreciation and accounting methods and the option of purchasing assets before year end. So maximize that QBI. If there's anything that I can have anyone take away from the last 50 minutes that we've spoken today, is you have to look at that 199 Cap A. You have to calculate that QBI deduction. I would do it sooner than later because you're running out of time between now and the end of the year to make changes that will help you maximize it. Some of the things that we're seeing in our office is consider converting independent contractors to W-2 employees. You can't take that in a vacuum. We've looked at that from some clients. For some of our clients, that may work. Other clients that have deferred compensation plans, we've ran those numbers, and it doesn't make sense for them to do that. So this is something that you need to look at on a case-by-case basis. There's no one-size-fits-all here. Review your S-Corp owner W-2 compensation. Now, this is something that we're doing across the board. Is it in excess of reasonable? So I mentioned a little bit earlier in one of those examples that I had a problem with the example because it didn't mention W-2 compensation for an S-Corp owner. S-Corps have to pay their owners, shareholder owners, a reasonable compensation for them being active in that business. Are the wages that are being paid for this S-Corp owner, are they in excess of what is reasonable? Because remember, the W-2 wages are not going to qualify for a QBI deduction, but the pass-through income from the S-Corp will qualify. So if you reduce the W-2 wages and reduce the wage deduction, you're going to be increasing the S-Corporation income and thus increasing the income that will qualify for a QBI deduction. So we're looking at that across the board and really focusing on, what is reasonable and is there opportunity here to reduce the compensation and allow the increase in the income. And also the wage calculation comes into the QBI calculation if your income is above the threshold. So this is something that has to really be looked at on a case-by-case basis. You may need those wages to be able to get the QBI deduction. So it's something that has to be looked at. If you are a specified service trade or business and you're approaching the income threshold, are there ways that you can reduce or defer income? Maybe you can switch to a cash-based. Look at those accounting method changes. Does that reduce or defer income? Can you contribute to a deductible retirement plan, a SEP or a 401k plan? That'll reduce your income. Can you accelerate deductions? Can you purchase assets, bonus depreciation, Section 179? Are there ways to get your income, if you're approaching that threshold, below the threshold? You have to look at this now that you're running out of time to make these kind of planning options available to you as you come towards year end. Another thing we're talking about with clients, it's not really a business related here, but is there an ability to bunch your charitable donations if you itemize? Remember, here in New Jersey, we're losing a significant property tax deductions and state tax deductions. Now, state taxes are high, our property taxes are high, and we're limited to $10,000 deduction if we itemize on our tax return. If you make charitable donations every year, you should look at the fact that the possibility of bunching those deductions into 1 year so you go over the itemized deduction amount and get some benefit for those charitable donations. Entity choice, lots of conversation around entity choice. The question everyone's asking us, should we change to C corporation? You have to remember that the tax deduction and the tax rates, for C corporation is 21% and it's permanent. These other provisions are going to expire, the 199 Cap A. The C Corp rate is permanent. C corporations still have a double tax. So you're going to be, the C Corp will be taxed when it earns the income, and then it'll be taxed again when it distributes that income to its shareholders. If the C Corp is accumulating that income rather than distributing it, then there's a possibility here for tax deferral as a C Corp. So if the C Corp is not distributing the income and is maintaining, accumulating it, it'll be taxed at 21% rather than distributing it to the owner shareholders and being taxed at the individual rate. You have to worry about accumulating earnings tax or business assets appreciating. That's going to affect your double tax within the C Corp. If they're appreciating, C-Corp may not be the best entity choice. And will the business otherwise qualify for a full 199 Cap A deduction? So you have to consider all of that if you're thinking about entity choice. One thing that we look at in addition to these is that if you're in a business, I know I didn't talk about the loss of an entertainment deduction, but if you're in a business where you pay high entertainment costs that are not deductible, it's really phantom income where the cash flow is being expended, but you're not getting a tax deduction for it. Having that non-deductible expense in a C corporation taxed at 21%, that's something else to consider, a point to consider. Choice of entity between partnership, LLC, or S corporations, as I mentioned earlier, wages paid to C corp shareholders, they get paid wages. Those wages qualify for the 199A computation. Partnerships and LLCs do not pay wages to their partners or members. If you're a partnership or an LLC, treat it as a partnership, and you're getting a W-2 and you own that partnership or LLC, you have a problem. You should not be receiving a W-2. You should not be receiving wages. It's a distribution and pass-through income for you. But if you're a partnership or an LLC, treat it as a partnership, and you are above the income threshold, and you are the only operator in the business, there is no wage calculation. So that's something to consider when you're looking at these entity choices between those types of entities. Tax planning, as we mentioned, should we be acquiring assets that we can take advantage of the Section 179 depreciation? I have some clients that always look at that at the end of the year. This year it's even more important because we could possibly take 100% deduction of those assets. And look at that accounting method. Don't let that one go by without giving it the attention that it deserves. It really could be something that could really change the tax and help you defer some income. So let me go back and we could open it up for some questions. Oops. Okay.
Thank you, Maria. So I know we're coming up on the top of the hour, and a lot of you might have 12 o'clock plans, either lunch or meetings, whatever. If you do, by all means, I'm not going to hold you. We are going to keep this going because we're getting a lot of great information, and I want to allow you guys to tailor the webinar a little bit more to yourselves during the Q&A. As a reminder, all of you will get the recording of this when it's done by email tomorrow, or it will be posted on our YouTube account at youtube.com/NJBIA. So don't feel like you're missing out on anything. You'll be able to watch this in its entirety after it's over. But for everyone else who wants to ask a question, you've got an expert here, so please make sure to take advantage of her. We have a couple questions here already, but I'm going to give people a couple seconds to type in anything they have. While I'm doing that, I'll remind you about the handouts tab. We get a lot of questions from people asking us how to download the slides. If you open up the GoToWebinar panel on the right-hand side of your screen, there's a tab marked handouts. You can download the PowerPoint right out of there. They'll also be emailed to you tomorrow along with the video recording of the webinar. And there's the questions tab. If you have a question, type it in right there and I'll make sure Maria answers it. And again, don't be shy. You have an expert here. So with all of that out of the way, let's jump right into our first question that comes from Zach, who would like to know, if I own an S-Corp and I pay myself a salary, does my salary qualify as wages in the wage calculation to determine QBI deduction?
Okay, so that sounds like we have an S corporation that has an owner that is receiving a W-2, and they have a calculation to make on the QBI. If their income is above the threshold on their individual return, yes, they can use their wages as part of that QBI deduction calculation. And that's where we're seeing a lot of planning in the S-Corp arena, around those S-Corp wages and the operations within the S-Corp. So, we're not minimizing the planning between S-Corps and LLCs and partnerships. Everyone's asking, should we become a C corporation? But we're also looking at the difference between partnerships and S-corporation structures.
Okay, our next one comes from Patricia. If I am an owner/employee of an S corporation, can I reduce my wages to generate more QBI in the business?
So yes, so this is a concept that I try to explain to my S-Corp business owners, that your wages that are paid to you are a deduction from your income, your business income. So you have your income, and wages are one of your deductions, and then you determine your net income. The net income that passes through to you onto your personal return, if you are a qualified business, not a specified service traded business, is going to qualify for the QBI deductions. The wages that are paid to you will not. So if you can increase your income that qualifies for the QBI, you're in effect increasing your QBI deduction. So yes.
All right, I've got one more here from Paul, but by all means, keep them coming and I'll keep throwing them out. I am in an industry where I pay my labor as independent contractors. Should I change them to W-2 employees?
Okay, you can't answer that in a vacuum. Okay, so there's planning that has to go amongst to look at that. If you need the wages as a part of your calculation to increase your QBI deduction, you want to take a look at that. In my example, we did look at a client that it was very common in their industry to pay their labor through independent contractors. And the number was significant, and they're not getting any benefit of any QBI because their income is above the threshold. And our first blush at looking at that said, hey, let's see if we can convert these independent contractors to W-2 employees and use the W-2 wages in the QBI calculation to determine the deduction. And when we ran the numbers, we were surprised it didn't make sense for that client. They had other things going on in the business. They, paying Social Security tax on the wages, the payroll tax compliance on the wages, and then they also had deferred comp plans, and the contributions to those deferred comp plans for those employees made it not a viable option, and we decided not to go with that route. But the point is that everything that we do under this Tax Cuts and Jobs Act has to be looked at individually. Every business owner, every business operation, every individual, it is so different case by case. There is no one size fits all. We're running out of time. Look at your numbers. Look at your at this QBI if you're a flow through business, and get that tax planning done before year end to take advantage of the increased deductions.
All right, I've got one here from William who asks, let me just rephrase this a little bit. Will New Jersey S corporations reducing salary to owners so that the NI passing through will be eligible for QBI result in higher New Jersey S corporation taxes?
The New Jersey does tax S corporations. There's minimum tax for S corporations. The S corp income passes through to the individual, and you're paying it on your individual tax return. So when you're looking at any of the tax planning under these provisions here, New Jersey is a state that will typically decouple from the federal rules, and you'll have to calculate your New Jersey tax. We had one client that we were, our first blush was, hey, maybe we elect to be a C corp for the state and leave federal S, or vice versa. You have to run these calculations through to see where the overall tax is going to wind up.
Carla asks, if I am a single member LLC with income above the threshold, should I consider becoming an S corp to pay a W-2 salary to myself? Also, I have W-2 employees.
Again, so you have W-2 employees, so you have an employee wage base for your calculation. When you pay yourself as an employee, or you convert to an S corp, you have to pay yourself reasonable comp. You're going to have to pay the self-employment tax, Social Security, Medicare tax on that compensation. As a single member LLC, you're paying it, but you're not paying the employer side and the employee side. So in that circumstance, I would run a projection with you having W-2 wages as if you were an S corp, calculate what the additional Social Security Medicare tax would be on those wages, and then also calculate what your QBI increase would be with those wages in your calculation. I would compare those two, and don't forget about the state tax, because I think William brought up a good point about New Jersey tax. Run your calculations both ways and make that determination. You have to actually run the numbers. That's the advice, run the numbers.
We have another one from William who asks, has the new law clarified business meals as still deductible at a 50% level?
So the new law has said that entertainment expenses are not deductible. We still are allowed the 50% deduction for business meals. Business meals on site was changed. So if you're providing meals to employees on site, those rules have changed, and entertainment has changed. Business meals are still at a 50%. Entertainment, tickets to sporting events, golf outings, those kind of entertainment are no longer deductible.
Do you anticipate that passive rental entities will be defined as eligible for a QBI deduction?
My feeling is we have a 100-year history of case law. We've had 162 out for quite a long time. We haven't gotten a definitive answer here. My gut is that we may not have a definitive answer here. It would be wonderful if we do. As I mentioned earlier, the AICPA's letter has 11 points, and their number one point in the letter is qualification of rental real estate as a trade or business. We're hopeful, but by year end, I'm not overly optimistic.
I've got one more here from William. If a law firm has gross income in excess of $25 million, are they still able to report income on the cash basis?
It's an average of 25 million over a 3-year period. If you're above the 25 million average in the last 3 years, you'll have to be accrual basis for your file. You can't go back to the cash basis. You can convert back to cash basis if you're below the 25 million average for the 3-year period. And that was once 10 million. So that's the change from 10 million to 25 million average 3-year period to go back to cash basis or remain cash basis.
Well, that looks like all the questions we have, so I think it's as good a time as any to bring things to a close. Don't forget, all of you will be receiving a recording of today's webinar and the PowerPoint slides via email. Lastly, when you close out of the webinar, a survey will come up on your screen that we hope you'll fill out so we can understand how to best provide you important information in a webinar format. Our next webinar, Outsourcing for Your Business, will take place Thursday, October 11th. So by all means, feel free to register for that one on our website at njbia.org. So until next time, from Maria Rollins, this is Vinny Civitello thanking you for being with us this morning and wishing you a great day.